you can have a sudden new entrant. If you got some tiny thing, gallium is really important, but it's not used in hundreds of thousands of tons. It's used in, micrograms in your phone or something, right? So if some private Chinese company, had a significant new mine and it was private, so we don't know it's coming, they could suddenly hit the market with new supply, assuming the Chinese allowed it to be exported, that we wouldn't know about. So the smaller oddball metals are harder to predict. They're more volatile, but the bigger ones, we can generally see what's coming. Silver bulls, I should get my Darth Silver mask here, except I'm not going to say that. I'm going to say, actually, no. It has gone up faster than I would have thought right now, because I'm actually a long-term bull on both monetary metals. I think this bull market has years to run. So I don't think we should be in that blow off top. Even the most diehard silver bulls would tell you silver lags at first and then more than catches up at the end, right? We all know that. So if we're in the silver catches up part, that implies we're towards the end of this bull market. And that's not my outlook at all. So to the degree that I had anything negative to say and deserved the Darth moniker this year, it would be that, I was unhappy that silver looked like it was catching up. And in fact, if you look at the charts from the bottom, not the peaks. I don't know why everybody likes to look at past peaks, but gains are calculated from bottoms, from troughs to peak. So if you look at the last bottom in 2015, silver has now caught up to gold on a percentage gain basis. If you're a long-term bull, that should be a concern. We don't want silver to catch up yet. We want, years ahead of bull market to run. So yes, I have been saying, be careful what you wish for. I don't want silver to do that, blow off top catch up thing yet. And so it was a concern that it went so high so quickly. But the reasons for that are not because somehow the debasement trade has gone into overdrive or the macro context has monetary metals going vertical. Gold is still sideways. Okay, we've come back up from 4,000 when we last spoke, but we haven't hit a new all-time high, whereas silver has, at least nominally. So it's specific to silver. It's not a monetary metals thing, it's a silver thing. And as many of your guests, I'm sure, have probably told your audience, they don't need me to wax rhapsodic about it. There have been supply issues in London and elsewhere. India's been loading up. So it seems to be, in my view, a silver-specific thing, which means it's probably not going to last forever. I expect silver to consolidate again at some point here. Maybe it goes up. The technical guys tell me it goes up to 68, something like that, just below 70, and then maybe corrects for a while. I don't know. I don't have a horse in that race. But the bottom line here is I'm not bearish because silver is doing that blow off top thing. I don't think we're there yet. I'm bullish because silver's gone up for idiosyncratic reasons. And if it corrects for a while, I think that creates buying opportunities before the next big leg up. So we kind of covered a couple things here at once, David, but I'm overall, the bottom line is I'm, for reasons that your audience is well aware of, very bullish on both monetary metals, and I'm not concerned about silver outperforming right now. I think that sorts itself out, and then we keep going on the trend that we've been.
Despite silver's strength, this is not a synchronized breakout across monetary metals. Gold remains largely range-bound, failing to push decisively into new highs. That divergence matters. When both metals surge together, it usually reflects currency debasement or macro panic. This time, silver's move appears idiosyncratic. Physical supply tightness, strong demand from India, and stress in key vaulting hubs have distorted the market. These are silver-specific forces, not a wholesale rejection of fiat money. That distinction suggests the rally may cool once those pressures ease, potentially setting the stage for consolidation rather than a dramatic reversal.
I think the big thing that's coming is a significant unwind of the AI trade. And whether that's actually the AI bubble popping in a waterfall event in the markets or something a little less harmful, I'm not sure. But it is really striking to me. You put up that chart today. That is the news of the day. But we also had not just the gap in the information from the government shutdown. We also had a bunch of furloughs of government employees that are now back on again, so that could reverse. Like this 4.6 number could be significantly lower next month because those people are back at work again. But we also had today, I thought something really interesting. I don't normally pay attention to, big mainstream names. But I'm blanking on the name. There was a billionaire hedge fund investor on Bloomberg this morning who talked about Mandami and talked about Europe and competitiveness. But the big thing that he said that really struck me was he was not necessarily bearish on AI, but he was basically deflating the hype and saying, look, everybody got all excited about AI, but I'm talking to big businesses, and yeah, they're using new technologies, they're modernizing, they're automating, they're upgrading, but they're not using ChatGPT. It's not a large language model that's helping them to reduce payroll, actually. And I thought that was insightful and important. Like, I've been chomping at the bit to use one of these models to help me in my research. And it's not just the hallucinations, it's the limitations of what they can do. If I need something to read everything on the internet and summarize it for me, then great. It can do that in a second faster than humans can do. If I need analysis, if I need understanding, I just don't think this is the right technology. And that's basically what the guy was saying. I think there's, and if that's true, and you're spending, what is it? OpenAI wants to spend $1.5 trillion building these data centers. And that's for this large brute force, large language model approach. If that's barking up the wrong tree, which, by the way, as DeepSeek has suggested repeatedly, right? There's a huge misallocation of capital underfoot. And again, that could lead to a market crash if people have this, oh my gosh, moment, or it could just be, a slower deflation of this balloon. But either way, the market concentration and the amount of money that's riding on this single thesis makes everything vulnerable to any correction in that space. So I know that we were talking about metals and other things, but you asked what's on my mind. I think this is on my mind. And to connect this to metals, like you can say, okay, well, serves those guys right for getting all hyped up about AI and all this bubble and everything. Fine. But the problem is that uranium has become an AI play because of the power needed for these data centers. Copper has become an AI play. Even silver. I've seen headlines saying that silver is an AI play.
Yes.
So if this thing unwinds, whether catastrophically or more in a less malevolent way, it becomes a headwind for everything, including, hard assets that you and I care about. Oh, by the way, good for Bitcoin either, which I know you care about more than me.
A pause or pullback in silver would not invalidate the long-term bull story. In fact, it would strengthen it. Bull markets rarely move in straight lines, especially in volatile assets like silver. A consolidation phase allows excess speculation to clear while preserving the underlying trend. Technical projections point to higher short-term targets. But even if silver overshoots, history suggests retracements are healthy, not fatal. Long-term investors should welcome corrections as opportunities, not fear them as failures. The core drivers, currency debasement, sovereign debt growth, and declining trust in financial systems, remain firmly in place.
Look at that chart, because I don't mean to interrupt. Actually, I do mean to interrupt, but I want you to look at the chart you've got on the screen now. Look at the lines. And yes, we had these big surges in 2000, but then we had years of consolidation and substantial drawdowns.
Yeah.
$2,000 for gold 2020, I think I can't see it chart, but I think that's what we're looking at. So that's what I'm saying. I'm not saying wait for gold to go back to what was the previous low, 1300 or 2001. I'm not saying to wait for it to go down to $258 an ounce. I'm saying that if people can't see what I'm pointing at, but that first surge on the left-hand side of your screen there, I wouldn't buy that. But months later, where it's wiggled down, then yes, I would buy that as long as I was still confident in the thesis. And
so would you,
from the beginning of our conversation here, I'm confident in the thesis. I just don't want to buy that spike on the right.
which of these would you still buy right now, given their moves already?
And you don't have it on there, but uranium too. This is exactly the thing. For people who are frustrated and saying, Lobo, it's going, and you're just sitting on your hand. No, I'm not. if you want to buy high and hope to sell higher, well, knock yourself out. I was taught to buy low and sell high. So when things, even if I like them, they're high, then I look for something else that isn't. And to go with your chart here, copper has afforded opportunities. There are copper stocks on my shopping list right now for this very reason. You can still find things that are available to buy low. And uranium is even better because the spot price has been highly volatile in the last few months, but the long-term contract price, which is the real uranium market, is actually going up. So if the real market's going up and the spot price has stocks on sale, my most recent purchases have all been uranium stocks because of that volatility. This is an old Doug Casey thing, my mentor. He used to say, make volatility your friend. That's exactly what I've been doing. And I expect to do that in gold and silver going forward.
Beyond metals, a larger vulnerability is emerging in equity markets, particularly around artificial intelligence. Capital concentration in a narrow group of AI-linked stocks has reached historic extremes. While AI adoption is real, expectations may be wildly inflated. Many businesses are modernizing but not revolutionizing productivity at the scale markets have priced in. Massive investments in data centers and computing infrastructure assume returns that may take years or never fully arrive. If that narrative deflates, the ripple effects could be broad, impacting everything from technology stocks to energy, copper, uranium, and even sentiment towards silver itself.
When you drill for oil, if you hit it, or gas, if you hit it, that exploration well is your mine. It is your production well, right? You cap it, you put the stuff on it, you connect it to the network and so on, and then you're in business, right? If you make a discovery, like if they announce tomorrow, like we hear all these crazy announcements and people get carried away. Oh, China discovers, $100 billion gold deposit. Like, even if that was true, usually it's not, by the way. It's just some guy's estimate of what it might be worth with no economics, no metallurgy, no hydrology, no engineering studies, none of the things at all that define the economics of a project. It's just some back of the envelope number by some promoter. But even if it was true, it would take years to build that mine. So supply is pretty price insensitive. Like, it takes years for high prices to cure high prices and low prices to cure low prices. Well, okay, high prices cure high prices on a higher frequency basis. But even then, if you've got a mine and it's not done, you're not just going to shut it off. You're very reluctant to put it on care and maintenance because that's expensive by itself. And you can kill the mine if you don't adequately put it on care and maintenance. So if you think prices are going to come back, you might continue mining even at a loss. Because you're going to take a loss on care and maintenance anyway, and B, if you shut it down improperly, you can lose the entire mine when it might have future value. So, high prices don't actually always cure high prices right away in the mining space. It's a slower moving thing. Now, and sorry, I won't go too far, but one more complication on the little oddball metals. That's much more volatile. You can have a sudden new entrant. If you got some tiny thing, gallium is really important, but it's not used in hundreds of thousands of tons. It's used in, micrograms in your phone or something, right? So if some private Chinese company, had a significant new mine and it was private, so we don't know it's coming, they could suddenly hit the market with new supply, assuming the Chinese allowed it to be exported, that we wouldn't know about. So the smaller oddball metals are harder to predict. They're more volatile. But the bigger ones, we can generally see what's coming. No, I just made an argument for silver having got ahead based on idiosyncratic issues, including supply, physical supply in the LME and in the COMEX and that sort of thing. And the reason for that argument was to say that, don't think that they're diverging permanently. Like, this is, I think, temporary, it gets resolved, and then both metals revert to trend. My base case, and by the way, this fits into why, even though I am bullish on both silver and gold, why neither is my top pick for 2026, is that it's entirely possible that we could see more consolidation at these levels before the next big move, which I do expect to be upwards. I mean, in 2020, we had to wait 3 years before the next big move upward happened. And I'm not saying that it has to be the same now, but I am saying that if it took 3 years last time, there's no reason, to assume that it has to, the next move upward needs to be right away. It could take 3 years, 2 years. Even if it takes a year and a half, we still have months to go. So I'm not bearish on silver or gold. The question is about gold. But I do think that there is a significant chance that both correct and consolidate for a while, possibly even all of 2026. And that's why, and whereas I'm highly confident that even with the short-term correction, copper goes higher in 26. And that's why copper is my top pick. To the answer for gold, central banks are still buying. The debasement trade is there. When people ask me, oh, gold's so high, how high do you think it can go? My answer is always, well, when do you think governments stop printing money? Or how low can the dollar go? I don't think there's a limit to those latter, and therefore I don't think there's a limit to how high the monetary metals can go. The difference between me and the Uber bulls who are just like buy today, right now. That's not me, because I'm willing to admit that it may be a while before I'm right about where it goes.
Periods of uncertainty reward discipline. Rather than chasing assets already in vertical moves, seasoned investors look for value where volatility has created mispricing. Uranium is one example. Spot prices have swung wildly, yet long-term contract prices continue rising, signaling real demand. Copper, tied to electrification and infrastructure, also offers selective opportunities. This approach reflects a simple principle: use volatility as an ally, not an enemy. The same logic will apply to gold and silver if they correct. The goal isn't constant action, but favorable probability. Buying assets with strong fundamentals when price temporarily disagrees.
All of them will be. I mean, there's optimism about peace in Ukraine. But we still don't have any word from Moscow that they're actually even interested in the peace deals the Americans and the Europeans and the Ukrainians are hammering out between themselves without Russian participation. So we'll see. But the most interesting of the three that you pointed out there is actually, I think, the investment scenario. One of the things that I know you've talked to our friend Rick Rule about is that the long-term average global portfolio allocation to gold has been 2% for decades. And recently it's only been around 0.5%. And Rick would say that if all it has to do is revert to mean, David, and that would 4x or produce 4 times the investment demand for gold. I think that's happening already. And I think that thing you just pointed out is evidence of exactly that. Now, I don't know that it goes back to 2%, but even if it just goes to 1%, that's twice the allocation of the past. That's a huge input factor. And I think we're seeing that. It's anecdotal. I can't prove this, but I listen to the talking heads on financial media, not you and I, of course, those other talking heads, mainstream financial media, which you will be soon, I'm sure, David. But anyway, you hear these guys, and instead of, treating gold like a 4-letter word, which it is, but, before, like, people would, if they mentioned gold at all, it was to laugh and sneer at the pet rock. Now, you see the money manager saying, oh, we're doing this with NVIDIA and that with Exxon or whatever. Oh, and we're hedging our bets with some gold too. Like that's coming up frequently in the conversations. And more recently, even the interviewers have come around to where the interviewers are saying, okay, well, that's really interesting. What about gold? You got some of that in there? Oh, yeah, we've got some gold too. So I think this is happening. I think this is something that's been absent for decades. I think it's material. We're talking about not just institutional investors, but, family offices and highly liquid, deep-pocketed investors that are getting the memo. And if you think about it, okay, in 2011, gold has this big spike after having been down for decades. It's easy to see why people would dismiss that. Recency bias would say, well, gee, that's a spike. It's a fluke. But now it's been 2.5 decades of rising gold. And if you pull back and look at the big picture since 1971, it's pretty easy to understand the thesis that gold offers. It's volatile. It goes up and down on every year. It can go one way or the other. But if you look at the big picture, it has held wealth. It has held value for the entire time that's been free to trade against the dollar, which has lost value. That chart, this is my favorite chart. You've seen it before, Dave. It's a giant X from 1971 to now. If you look at the the exchange rate between gold and the dollar, and you look at the dollar's purchasing power, even using the BLS's CPI as input, it's a giant X. And that has lasted decades. And I think people are starting to understand that now. And that is something that's completely new. I think that's as big a game changer or a paradigm shift as the central banks deciding to hoard gold. Yes and yes. So an interesting thing is that you're putting gold on here versus other investments. And in a way that shouldn't, well, a couple of things. One is if you put silver, platinum, or palladium on there, they'd be even bigger than gold. But this isn't your chart, I understand. But I think it's actually comparing apples to oranges here. Gold is not an investment. It is, I think, money. It should be compared to the dollar, not to other investment classes. So if you want to compare a gold-based investment to these other investment classes, you should put the gold stocks on there, put GDX on there. And that's up over 100%. It's like 140% or something last I saw. So it's even better. If you compare gold investments or speculations versus these other investment classes, I think you see an even bigger outperformance. But to the question of what is this signaling, this ties into the earlier conversation that we kind of put the cart before the horse here in my concerns for 2026. As you may remember from our previous conversations about the Big Mac index and other things, gold does not correlate well with inflation. You know this. I've heard you talk to other guests about this. The correlation is actually not negative, but it's basically negligible.
Yes.
And the reason for that we've discussed before is that gold tends to lead. Right? Gold went way up in 2020, and it wasn't until a couple years later that inflation went up to 9%, at least as officially admitted by the United States government. So what does that imply about what gold is doing now? I think that's pretty scary. And I'm not going to, write a science fiction story for the audience in some apocalyptic scenario. But if past is prologue, right? History doesn't necessarily repeat, but if it rhymes at all, gold going to where it has gone and silver confirming it and the other so-called precious metals tagging along, I mean, that's pretty scary. We just talked about deep pockets hedging with a bit of gold. What are they hedging? What, not just, when we say what is gold telling us, we're really saying, what are the buyers worried about? I think that's significant. I think people should pay attention to that. Sorry, real quick. I just said I'm allergic to buying all-time highs, but I'll tell you, if I had no gold, and I just said gold's not an investment. I view gold as money. I view it as savings. I have physical bullion. I won't tell you which palm tree it's buried under, but under my direct control, that is my rainy day fund. And I have lived this in the past. I have used bullion to save my family in times of trouble. So I take this very seriously. If I didn't have that, this is what I'm saying. If I didn't have that, you know what? I would be willing to buy gold today, even at these prices. If I had zero physical gold, if I didn't have gold or silver I could hold in my hand, I'd go on the Costco website today and buy some.
And hold it long term.
That's my answer to, what is gold telling us? It's telling us, I don't know what it's telling us, but it's not good, and I want insurance. And
that's the
first line of insurance I'd buy.
Gold's message is subtle but unsettling. It does not track inflation directly. It tends to lead it. Historically, major gold advances have preceded periods of economic strain rather than followed them. Meanwhile, portfolio allocations to gold remain well below long-term norms, even as central banks accumulate aggressively. That gap alone implies substantial future demand. Increasingly, gold is no longer mocked. It's mentioned casually as insurance. That shift matters. Gold is not a trade, it's a reserve. And when serious money quietly adds protection, it suggests concern, not confidence, about what lies ahead.